Welcome back to Yahoo Finance Live. Let's take a quick look at the markets right now. The Dow, the only one in the green, up about 142 points. We've got the S&P 500 trading pretty flat, and the NASDAQ down as well. Our next guest says markets have been reacting to signs of peak inflation, but it's probably a bit early to celebrate. Joining us now is Marci McGregor, senior investment strategist at Merrill and Bank of America Private Bank. Marci, it's good to talk to you today. You know, we were just talking at the start of the show here about whether, in fact, investors are starting to say, well, look, we're kind of hit peak inflation, that things will be a little smoother going on out. Sounds like you're a little more cautious on the other end.
Yeah, we're staying on guard. CPI still is 8.5%. So I'm a little confused why everybody is so excited. I think we have early signs that we're in a peaking process, but no 1 month, no one data point makes a trend. I need to see a few months of data to convince me that inflation has peaked and is coming down the other side. I think we're going to hear from the Fed at Jackson Hole that they are resolute in their fight against inflation. They're going to keep removing liquidity because, frankly, they have a lot more wood to chop.
Hey, it's Brian Chung here. So your notes mentioned that Bank of America is forecasting a mild recession starting in the fourth quarter. So it sounds like none of the data is convincing you otherwise. But then also, what is a mild recession in your view?
Yeah, so I think we're not in a recession yet, but we've had zero real earnings growth this year. It's been all about nominal. I think we're going to see some softening in the labor market as we get to the end of this year. We're forecasting about a 1% pickup in unemployment. I think the consumer will stay pretty firm throughout this, and that's why we're saying it's mild. I think this is going to be more about corporate profits. We're forecasting about an 8% year-over-year, negative 8% year-over-year growth rate next year. And that's what I don't think the market has priced in yet. So I think it's a lot more about profits than it is necessarily about the economy when we see this slowdown coming.
Yeah, Marci, when you look back to the gains we've seen over the last few weeks, I mean, you could argue, yes, the inflation print and economic data helped, but a lot of this has to do also with better than expected earnings. I mean, how much of that has been supportive of the gains we've seen so far? And what does that tell you about how things are likely to move going into year end? Does the attention then shift back to the Fed?
Yeah, so I think there's definitely some relief that earnings were less bad, were better than feared. But when we saw the market's reaction to earnings, there wasn't a lot of rewarding winners and punishing losers in there, which tells me this is a more macro-driven market. So listen, I'll take the good news where I can get it. Earnings being less bad is certainly, a good thing. But I think with, again, no real growth this year and inflation starting to come down, it's the nominal growth really driving sales and that top line number. So I think that effect is going to wane. And frankly, I think consensus is just a bit too optimistic about 2023. We've seen cuts to forecast for the second half of this year, but we haven't seen meaningful cuts for 2023. And I think that's going to play out when we get to the fall. And I think we're probably going to get more volatility around the Fed. Let's not forget that it's an election year. And then once we get to fourth quarter on more management guidance, you get those earnings cuts. And that's where I think the market's likely to experience some more volatility.
So does that kind of support the view that you maybe want to position yourself as a patient bear, as we were kind of discussing in the last segment? I mean, there is kind of the optimism that perhaps we've gotten past peak inflation, but you still don't see a lot of fund managers saying, look, we're really willing to get risk on at this time.
Yeah, my colleague at B of A did use the term patient bear, and I like that, right? You do have to be patient in bear markets. The worst may be behind us, but we're staying on guard because I think you're going to be in this kind of wide range-bound market for some time. Again, until we get kind of more clearance on the macro front, more reset on the earnings front. So I think we get this choppiness. So I think it's about being really balanced and really diversified in an uncertain world. I think that means sticking to higher quality investments, things like dividend payers. I know it's not the most exciting story out there. And then finding a balance when it comes to sectors. We still like sectors like energy, which have been really doing the heavy lifting in terms of earnings. But I would balance that out with more defensive areas like utilities, healthcare, even consumer staples to give that balance back to portfolios.
Yeah, within that portfolio, I mean, how much would you say investors should be putting aside, sort of leaving cash on the side? I mean, that's something that we heard so much of. We've seen more and more of that being deployed over the last few weeks. But, I mean, is it still better to stay invested broadly?
I think it's really important to stay invested. Market returns since the June lows, and especially the month of July, tell us that missing the rebounds is what's really painful for our clients. So we are neutral equities overall. We do have a little bit of cash on hand because we do think we're going to get more opportunities later this fall to reallocate. But we've actually been raising our allocation to bonds. Now, again, it's high quality bonds. It's things like investment grade, a little bit into treasuries and muni bonds. Again, not taking a tremendous amount of credit risk there, but we've been adding to fixed income because given the move in rates this year, I just think the risk balance is a little bit more two-sided right now in fixed income. So neutral equities, staying on guard, watching for volatility, but we do have a little bit of extra cash that we'll be ready to position, I think, once we get towards the end of this year.
All right, patient bears, I guess, is the key phrase there. Marci McGregor, Senior Investment Strategist at Merrill and Bank of America's Private Bank. Thanks so much. Appreciate it.